Bring in Barry Knapp, managing partner at Ironsides Macroeconomics, and Stephen Ricchiuto, chief U.S. economist at Mizuho Securities. Barry, you say the market has fully discounted your worst case outcome. How can that be when earnings expectations are still so high?
Well, I think you'd have to consider what kind of a recession we would have were we to fall into, not just the technical definition, but one that the NBER described as a recession. And you have to go back some time to really look at what happens during inflationary recessions where the Fed tightens policy enough to cause us to go into recession, and compare it to the last three prior to the pandemic, which were credit cycles. And those were fueled by bank credit. We had the commercial real estate collapse in the late 80s, leading to the savings and loan industry collapsing. That was a credit cycle. Earnings dropped some 28%. We then had the tech bubble burst. That took technology earnings down massively and brought S&P earnings down 31%. Again, a portion of the build out of the internet was financed through the banking system, so it hit bank profitability as well, roughly in 2002 when WorldCom and Global Crossing went under. And then, of course, we know what happened during the global financial crisis. But if you compare that to 1969, 70, even the deep 73 to 75 recessions, 81 to 82, or more appropriately, the 80 recession, you tended to have real growth drop, but nominal growth continue to rise. And even in those long 16-month 73 to 75 and 81 to 82 recessions, you had fairly shallow earnings declines of something just greater than 10%.
Okay.
What's more probable is we had something like 1980 where we had a 6-month recession and earnings only went down 4.
All right. But now, Stephen, I can imagine a scenario where inflation remains stubbornly high, even though growth slows and the Fed's got to keep hiking. Do you think that is priced in?
No. Well, yes and no. I don't believe it's priced into the market, nor do I believe the actual economic pain that's going to be felt is priced into the market today. My view of the situation is very simple. The Fed's not going to reverse policy course, as a lot of people anticipate. I believe when the Fed inflects, it's not a pivot. It's simply an inflection. And the pace of rate hikes slows, i.e., instead of getting to 4%, as James Bullard would like us to get in a very, very quick near future, it could take us a year plus, year and a half to get there as the Fed goes back to a series of 25 basis point rate hikes, perhaps staggered out one per quarter as we go into 2023. And that's a different scenario than we've seen in all here, because I don't believe this is going to be a recession. I don't believe there's pent-up demand. I don't think there's going to be a strong rebound from this slowdown that occurs. I think the economy is going to return back to a very shallow, sub 2.25% growth trajectory once we're done with this deceleration environment that we're dealing with today.
And when is that, Stephen? When do you think we're done with it?
It's going to take us a good 5 quarters to get through it. You can argue whether we're already into it for 1 or 2 quarters or not. I think we're not going to be out of this malaise until we get to the first quarter of next year. And clearly that's not priced into the equity market at this juncture from at least my analysis. Okay,
so Barry, you don't think that we're necessarily going to get called as being in a recession anytime soon. So is there anything in particular that you're going to be watching for in these Fed minutes to either ratify or challenge that?
No, not really. I think the big question for the Fed minutes are going to be how much did the decision hinge upon inflation expectations relative to the actual inflation data, which clearly has peaked. I think they've got a little egg on their face with respect to having overreacted to the preliminary estimate for Michigan's 5-year inflation survey, some 500 respondents. It went to 3.3, and then when they got the rest of the data, it was only 3.1. It looks like a little bit of an overreaction, but clearly inflation has peaked on the good sides. We're going to get another round of housing data for the month of June by the next FOMC meeting. That's the cutting edge of Fed policy, right? That's really where it will intersect with the real economy. If that looks soft again, they're going to start to think, okay, we've slowed it. And I agree with Steve's assessment that the pace of of tightening will slow. And that's part of my broader thesis here is we are past the maximum point of pain when that in terms of tighter policy. When that happened in 94 in November, that kicked off a very significant equity market rally. We got the 75.
I hear
and then
you.
equities took.
I mean, but when you say inflation has peaked, I get flashbacks to March, April, May, and that's it's one thing to be past the maximum point of pain, Stephen. It's another thing for the pain to actually ease. I mean, maybe inflation has peaked, but how long is it going to ride around at this really high level, and what are the impacts if it does?
Yeah, longer than people think. And that's why there is going to be no reversal in monetary policy this time through, and why the Fed, even though they will slow the pace of rate hikes, will have to continue it throughout the entire expansionary period. In addition to that, I think when you're looking at today's minutes, you want to look for the degree of discord there was over the 75 basis point move. Now, we do know we had one dissension from the 75 basis point move. And remember, it came just a short period of time after the chairman had taken 75 basis points off the table, and then they leaked it through the back door that they were going to go 75 basis points. So the question is, how broad-based was that push for 75 basis points versus how much pushback did they actually get against it? And did they decide to go with it from a voting standpoint? But there was a lot more heated debate than we think. That's going to be critical. I bet we come out of this and there wasn't that much of a heated debate, and therefore it keeps alive the whole concept that the Fed could go 75 basis points and will actually keep on going more quickly than the market currently anticipates. We had a big rally at the front end of the curve, and I think that rally is probably overdue at this juncture.
Yeah, well, yeah, the Fed's probably more in sync than the Supreme Court. We can probably bet on that at least. Barry Knapp, Stephen Ricchiuto, thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.